In the UK, we're obsessed with home ownership, way beyond other countries. It's seen as a milestone in life, a rite of passage, and a sign and a symbol of maturity. Unless you're minted extremely lucky, or you've inherited lots of cash, or in fact a property itself, then the main way for you into home ownership is going to be a mortgage. It's likely to be one of the biggest purchases you ever make, the most amount of debt you're probably ever likely to take on, and it's going to make up a substantial part of your monthly wages to pay it off. But yet we're not, at least I wasn't, taught anything on this subject in school. It's a critical thing, and for some reason it's just not taught to us. Unless you're lucky enough to have parents to explain it to you or walk you through it, we're just left in the dark. Now, I'm not going to go into detail as to why this is, or conspiracy theories. I mean, you'll be here too long. But what I'm going to do is go over the basics of mortgages. So we're just going to go over the fundamentals that surround mortgages, the different types, how they work, and just a few little underlying principles. So let's get into it. Put simply, a mortgage is just a long-term loan, especially made for buying property or houses. The loan is given to you what's called a lender. Now, this could be a bank or a building society, and it's secured, or it's tied to the property itself. This means that for whatever reason you can't repay the mortgage or the loan, then the lender can actually sell the property in order to get the money that's owed to them back. And for this reason, it's very, very safe for the lender, because there is something to back up the money that they're actually lending. Now, undoubtedly, the hardest part of buying a house for anybody is usually saving up a deposit. So in the UK, we can no longer buy houses on 100% loans or mortgages. So you're going to have to put in a deposit. Now, think of it like this. The foundations of a house, that is your deposit. Without the foundations, or without your deposit, then you're not going to get a house on top of it. What your deposit also does is it means that the lender is not putting in the whole amount of the money for the property. So if for whatever reason it lost a bit of value and then you couldn't afford to pay and they had to sell it, they're more likely to get all of their money back. So you put down your deposit and the lender's loan makes up the rest of the house value. Now, the amount of deposit you put down is expressed in a percentage of the house value. So usually the minimum is around 10%, and you can put anywhere up to 100%. But at the moment, if you're a first-time buyer, you can get a 5% deposit mortgage. That is currently available at the time of making this video. It might not be around forever, but it is available currently. The size of your deposit gives you the LTV, which is the loan to value. And put simply, this is how much the loan is compared to the value of the house. So say you had a 100 grand property, just make it nice, easy numbers, and you put a 10% deposit in, that's going to be £10,000, 10% of 100 grand. Then the LTV you would need on the mortgage would be 90%. 90% loan to the value of the house, which in this case is £90,000. In return for lending you the money to buy your home, the lender charges you an interest rate. And this is the cost of borrowing the money off the lender, and it is put on top of the amount you owe. This is so the lender can make a profit. After all, it's a business and they're not going to do it for nothing. Now, this interest rate that you're going to get from the lender, this varies on quite a wide range of things. So we're just going to go through a few of them now. First one being what percentage deposit you actually put down on the house. So typically a larger deposit will mean a lower interest rate, and the smaller the deposit usually means the higher the interest rate. But it is always worth checking these out, because sometimes they don't change. It's like if you get higher up, say you're 35% deposit level, I know it'd be nice, and you went to 40%, the rate probably be roughly the same, but something like a 5% deposit will be quite high interest rate compared to a 10% or a 15% deposit. Then we have your risk level, or if you're applying in a couple, the risk level between the pair of you. And this basically is done by your credit score and your credit history. So with this, the rates, middle of the road, so if you've got an okay credit score and a really high credit score, you're likely to get the same-ish rates. If you've got a really bad credit score, you're likely to get a higher rate. And this is basically because you have a smaller group of people to choose from when you're looking at lenders. And if you've got a really good credit score, chances are more lenders want to lend to you. That's why it's really important to check out your credit score. You can do it on places like Credit Karma or Experian if you're going to get a mortgage for the first time, or if you're going to remortgage, before you do it, a good few months before you do it, you just want to check, make sure everything's in order. And if there's something that isn't for whatever reason, you have a chance to fix it or pay down debts or whatever you need to do to try and get that up to give you the best chance of getting a better rate. Now, the next one is completely out of our control, but it's the economy or the Bank of England base rate. What is the Bank of England base rate, I hear you ask? Well, this is the cost of the lender borrowing money in order to lend to you. So it effectively borrows it off the Bank of England and then lends it back out. So the rate that you pay, your percentage rate you pay, will be a combination of the Bank of Interest base rate and then the margin put on top by your lender. So say it's 1%, the Bank of England rate, and your lender puts 2% on top of that rate as their profit margin, then you pay 3% on the interest of the loan that you receive. Now, when it comes to mortgages, there are two main types, and that is a fixed rate mortgage. This is where you freeze the interest rate at the time you take out the mortgage for a set amount of time. This can be 2, 3, 4, 5, some lenders even 10 years. And that means for that set amount of time, your payment is not going to change. You're going to lock in that price and you're going to pay that for the full introductory length, which is the 2, 3, 4, 5, 10 years that you set. And after that, you will go on to the second rate we're going to talk about in a minute. Now, you'll have a chance to, at the end of that time period, remortgage, so find a new fixed deal, or you can do something different. Now, the second type is a variable, also known as a tracker mortgage. And this can change through different reasons. So maybe your risk level changes for whatever reason, if they check up on it. Or maybe the Bank of England base rate changes. So typically a lender, if your risk level stays roughly the same, they will set a percentage above the base rate that you will pay. So again, we go back to our example. If it was 1% Bank of England base rate and they put 2% on top, you'd pay 3%. Now, when the Bank of England reviews their base rate, they could put that up. Say they put it up to 1.5%. Now you have your 2% on top from your lender. Now you're paying 3.5%. So your payments can go up or go down anytime any of these things changes. When you apply for a mortgage, you decide how long you want to take the loan over. And typically this is 25 to 35 years, but it can be a lot shorter and it can be a little bit longer. So for instance, mine's 37 years. You also have to decide if you want to take out a repayment mortgage or an interest only mortgage. Now, repayment mortgage is pretty self-explanatory. It's by the end of the period, so my 37-year period, at the end of that period, if I've made every payment, I would have paid off the house or the loan on the house and would have paid off the interest on the loan. So everything would be paid off. I would be the complete owner of my house and that would be it, job done. Interest only, again, very self-explanatory. You're only going to pay the interest. Now, it's a little bit confusing, this one, to some people, but you're only paying the interest on the loan amount you took out. So in our example, we took out a £90,000 loan and say we took it over 25 years. So in 25 years time, we make all our monthly payments, but at the end of the 25 years, we've only paid the interest and we still owe that £90,000. So at that point, you'd either have to take out another mortgage or you'd have to pay off the loan amount in full. So this is just a very quick whistle-stop tour of mortgages, and it really shows that there are so many variables, and every variable has its advantages and disadvantages. And it's not until you get into the more nitty-gritty that you start to work out these advantages and disadvantages for yourself. And usually it'll be a case of your circumstances at the time or your goals, and that will give you the product that you require to fit them needs. Now, if there's any parts of this video you want me to go over in more detail, leave a comment in the description down below, and if there's enough interest, I'll be sure to do a video on it to explain it in more detail. Thank you for staying to the end. I'll see you in the next one.